The countdown has begun. On May 14th, the Senate Banking Committee holds a decisive markup session for the Clarity Act, a 300-page amendment that could redefine American finance forever. Lawmakers have until the end of May to move this bill to the floor. If it misses this window, political analysts warn the legislative window will effectively slam shut as midterm campaigns take priority. The administration's target is July 4th. Passing the act by Independence Day would allow for reconciliation between the House and Senate versions before the critical August recess. At the heart of the act is the resolution of the SEC-CFTC turf war. Decentralized networks migrate to the CFTC as digital commodities, while centralized entities remain under SEC oversight as restricted assets. The process is clinical. Issuers file for decentralization, and the SEC has exactly 60 days to rebut. Without a challenge, the asset moves into the clearer waters of the CFTC's jurisdiction. This is the evolution of FIT 21. While its predecessor stalled, the Clarity Act cleared the House with an even stronger mandate, fueled by 78 Democrats joining the majority. But the friction remains in Section 404. To prevent stablecoins from acting as unregulated bank deposits, the Act prohibits issuers from paying passive interest to retail customers. A May compromise between Senators Tillis and also Brooks has broken the deadlock, allowing for transaction-based rewards while maintaining the hard ban on deposit-like yield. If signed, a 360-day implementation clock begins. This would trigger a massive wave of federal registration and disclosure filings throughout 2027. But the campaign wall looms. Senate observers note that meaningful floor votes rarely occur after August. If a deal isn't finalized now, the bill may be shelved for years. Analysts currently place the odds of passage at 50-50. The outcome depends entirely on whether Senate leadership prioritizes digital asset clarity amidst a crowded legislative schedule. We are at 0 hour. The decisions made in the next 90 days will determine the jurisdictional map of American digital assets for the next decade. Institutional finance has entered a new phase of integration. Wall Street isn't just buying Bitcoin, it is weaponizing the ledger through sophisticated arbitrage and risk management machinery. A massive portion of institutional shorting is tied to the basis trade. Firms buy spot Bitcoin through ETFs while simultaneously selling futures to harvest the price premium. But by early 2026, the profitability of this trade began to compress. Annualized yields plummeted to 5%, triggering a massive institutional retreat. Giants like Brevin Howard and D.E. Shaw slashed their positions by over 80% as returns approached the level of traditional risk-free assets. This unwinding of the basis trade often appears as ETF outflows, but it isn't necessarily bearish. It's a calculated exit from a crowded arbitrage trade. The first quarter of 2026 saw nearly $2 billion in combined net outflows, creating a narrative of institutional panic that the data doesn't fully support. BlackRock remains the heavyweight. IBIT continues to command the deepest liquidity, often acting as the sole absorber of capital during broader market drawdowns. The concentration of coins is extreme. U.S. spot ETFs now control roughly 7% of the total circulating supply, reducing the tradable float and heightening volatility. We've moved from emotional volatility to mechanical volatility. Large allocators are now forced to sell systematically whenever Bitcoin exceeds its target weight in their portfolios. These systematic sales are unrelated to the asset's fundamentals. They are the rigid rules of institutional risk management manifesting as market pressure. Yet, whale influence persists. A single $72 million short position opened in May sparked a wave of speculation, proving that leveraged individuals still move the needle. Regulation is the final unlock. The Clarity Act's markup session on May 14th marks the end of the turf war between the SEC and the CFTC. By designating Bitcoin and Ethereum as digital commodities under CFTC oversight, the Act provides the permanent legal status that institutional trustees demand. The floodgates are opening. Major wirehouses like Morgan Stanley are now recommending up to 5% Bitcoin allocations for their discretionary clients. Even the most dedicated holders are shifting. MicroStrategy broke its never sell narrative in May to fund shareholder dividends, signaling a move toward mature corporate treasury management. This is the peak of the conflict. Short interest has reached a boiling point as Wall Street tries to time the transition from speculation to utility. The siege of the ledger is about who controls the narrative of value. Institutional scale is meeting the immutability of the blockchain. Wall Street isn't attacking Bitcoin, they are digesting it. The siege is ending, the integration is permanent. The evidence is clear. The legacy system is no longer fighting the new ledger. It's becoming part of it. I'm Ananya, reporting for Global Crypto AI Pulse. Thank you for watching.